Okay, let's go ahead. Welcome everybody. Happy Friday. This is Ilian Yotov. Welcome to the weekly Outlook webinar. By the way, next week is going to be the final week of the month and of the first quarter of 2011. So it should be an interesting week. It's maybe a little more volatile than normal. I'd like to welcome you aboard, and I'd like to thank our friends at fx3.com for putting together these series of webinars. Thank you for joining us today. My name is Ilian Yotov. I'm familiar to many traders as the creator of the Quarters Theory, and also I'm hosting a popular daily program, the All Things Forex broadcast, which I've literally wrapped up about 30 minutes ago. You can listen to the program, the All Things Forex broadcast, on my website, allthingsforex.com. every Monday through Friday. If you miss the live program, you can always listen to the archives that are available on allthingsforex.com. Now, without further ado, let's take a quick look and prepare for the trading week next week. I'll give you the top 10 spotlight economic events, and I will give you the outlook for the consensus forecast for the upcoming events, for the outcome of the economic data, and we'll also explore the outlook for the currency majors, including the US dollar, the euro, the yen, and the British pound in the trading week. Okay, the very first of the top 10 events next week is going to come from the Eurozone with the German IFO Business Climate and Expectations Index. Now, this is a leading indicator of economic conditions. It follows the ZEW Sentiment Index, and the consensus forecasts are expecting that there may be slight improvement in the outlook of the Business Climate Index. This is a survey, by the way, of businesses gauging their outlook and current and future economic conditions, expectations for future conditions. The German IFO Business Climate Index is expected to climb a little bit higher to 109.8 from 109.6. Nothing spectacular, really. A small increase, and I actually would not be surprised if that index comes a little bit lower, considering, I'm not sure if you paid attention to yesterday, but very important report yesterday from the Eurozone. Very disappointing with the purchasing managers indexes from the Eurozone and from Germany, the largest economy there, lower than expected, below 50, which, as I explained last Friday, is in contraction territory. It begs the question. I spent my All Things Forex program yesterday discussing that. It puts into question this whole story about a recovery in the Eurozone in the first quarter of 2012. Now, many of you will recall that the fourth quarter of 2011, the Eurozone economy contracted, and some were expecting that now we're starting to see some signs of improvement in the first quarter. Maybe the Eurozone economy is not going to contract in the first quarter of 2012, but that whole expectation has been put into question as of yesterday, especially with that disappointing purchasing managers indexes report. And as a result of that, we could see another consecutive quarter of negative economic growth in the Eurozone. If you have two consecutive quarters of negative economic growth and contraction, that's the definition of a recession. So what does that mean for the euro? If the Eurozone economy does not improve in the first quarter of 2012, then the odds will be increased that the European Central Bank could do more to stimulate the economy. As we also noted, Eurozone officials are now beginning to get more focused on creating economic growth, acknowledging the dangers of this potential double-dip recession. Of course, we'll have to wait until next couple of months to see the estimates for the GDP numbers and how the Eurozone economy did in the first quarter of 2012, but there are suspicions that we may be in for another second consecutive quarter of negative economic growth. That means a double dip in the Eurozone economy and ultimately raises the odds of the European Central Bank doing more, including further interest rate cuts to stimulate the economy, and that, in my opinion, would hardly be a beneficial fundamental factor for the euro. Throughout next week, we're also going to keep an eye on the sequence of important U.S. economic data. It will really give us an opportunity to gauge the conditions economically on both sides of the Atlantic, as we have done diligently every single week on this program. And of course, in the first quarter of 2012, we're starting to see some of those relationships, the inverse relationship between U.S. dollar strength and risk being U.S. dollar strength and weakness, depending on the risk, depending on how the equity markets, how the markets and investor sentiment does in general. Some of that inverse relationship is beginning to come to an end in the first quarter of 2012, and it could continue further in the upcoming second quarter of 2012. Now, what do I mean by saying an inverse relationship? Now, for the last several years, it's been a pretty straightforward kind of an inverse relationship. The dollar weakens as a result of investor sentiment improvement, more risk appetite, and vice versa. The dollar strengthens in periods of more risk aversion. However, in the recent months, we're beginning to see, as I have warned on this program, that this inverse relationship could start coming to an end, especially if QE number 3 expectations, the expectations for more quantitative easing by the Federal Reserve, begin to diminish. In other words, if the U.S. economic data continues to show signs of improvement, if the U.S. economy continues to strengthen, then that reduces the odds of the Fed doing more quantitative easing. And ultimately, as I've explained months ago, that would help the U.S. dollar going forward. This is what we'll continue to watch throughout next week, as well as into the second quarter of 2012. And this is why it's going to continue to be important for the U.S. economic data throughout next week and in the weeks and months to come to continue to show signs of improvement and signs of strength, to keep the odds of more quantitative easing by the Fed reduced. On the other hand, if we now see the market begin to price more aggressively that the recovery in the Eurozone in the first quarter that was expected was more of a wishful thinking rather than a reality, then we can start seeing divergences being priced in the expectations for the future monetary policies of these two major central banks. In a way that if the Eurozone data does not improve, if the Eurozone economy does not improve, that raises the odds that the European Central Bank could continue to stay accommodative, including considering further interest rate cuts. While, on the other hand, the Federal Reserve could continue to steer further away from doing more quantitative easing, and it could potentially consider an exit from its ultra-accommodative monetary policy sooner than the promised period. Remember, they recently committed and promised that they're going to keep rates in a target band between 0 and 0.25%, which is practically at 0%, where they have been since December of 2008. The Fed committed and promised that they're going to keep them at that level until late 2014. But if these expectations begin to be repriced, that the Fed might exit or start hiking rates sooner than 2014, while the European Central Bank or other major central banks for that matter consider staying accommodative, then that is going to be a major factor going forward, I think, that could continue to lend strength to the U.S. dollar. Now, let's take a look at the euro-dollar currency pair. We'll take a look at the daily chart of the euro-dollar pair. And as my forecast last week is that we more than likely are going to see more of the same this week. And by saying that, I meant that it's more than likely that throughout this week, we're going to see the euro-dollar pair confined within its existing range. Now, I've given you the lines here in the last couple of months. the euro-dollar pair has been confined in a range which is roughly between $1.30 and $1.35 level. A couple of identical highs, a double top resistance was established at $1.3485, serving as the top of the range, and $1.30 level approximately serves as the bottom of the range with the recent lows at $1.3002 and $1.2973, just a little bit below the $1.30 level. As you can see, in the last several trading sessions, pretty much throughout the current trading week, the euro-dollar pair has been settling within the middle of this range. This week, neither the bottom of the range at $1.30 nor the top of it at the $1.3485 have been challenged. As you can see, the range is tightening even more, and there's some strong resistance ahead for the euro that the euro was not able to break above decisively this week. The first level of resistance is $1.3090. Well, today we reached a couple of pips higher at $1.3092. And then above that, we have $1.3021. The euro must break above these levels decisively in order for it to challenge the top of the existing range at $1.3485. If it doesn't do so next week, then the euro could continue to stay under pressure and could head again lower to challenge the support level at $1.3144 from October of last year. This level this week is serving as a major level of support yet again, with the euro finding support yesterday at $1.3334, which is only 10 pips of an overshoot below $1.3144. So if $1.3144 level is not broken below, then the euro may not be able to challenge the bottom of the range at $1.30. So these are very important support and resistance levels ahead for the euro-dollar pair that we need to carefully monitor throughout next week. And a breakout, it has to be a decisive breakout, of course, not just 2 pips or 10 pips of an overshoot above or below these levels. A breakout above $1.3321 or a break below $1.3144 could tell the story that could point to another 100 to 150 pips of a move, either up to the top of the range for the euro-dollar pair or down to the bottom of the range around $1.30 for the euro-dollar pair. At this point, the euro is simply settling at the end of the trading week this week in the middle of that range, which, by the way, is also an important price level in my quarters theory, being the large quarter point at the $1.3250. As I recently explained, this range is pretty much within the range of 2 large quarters of 250 pips each, from $1.30 to $1.3250 and then $1.3250 to $1.35. This is where the euro-dollar pair has been fluctuating within since pretty much mid-January. So it's a couple of months that the euro-dollar pair is confined within this range. Let's see here. I think we have a question. The second spotlight event next week is going to come from the United States, and that's going to kickstart the sequence of important economic data from the United States throughout the week, from Monday through Friday next week. Pretty much every single day, we're going to have an important economic event from the United States. We're going to start on Monday with the pending home sales index. Throughout this week, the sequence of housing data from the U.S. has not been impressive at all. Moreover, it's actually been on the weak side. And I'm not expecting that the pending home sales index, which is a leading indicator of future housing market activity, is going to be that positive on Monday either. As a matter of fact, the consensus forecasts are pointing to a smaller increase by only 1% month over month in a pending home sales index. That is compared with a 2% increase month over month in a previous month. However, the rest of the economic data from the United States throughout next week looks to be more on the positive side. So the pending home sales index is going to be on the weak side, and that's not surprising because the housing market still has much to be desired before it improves significantly. It's also a lagging type of a sector that lags behind the improvement in other sectors. especially following the labor market. Obviously, if a person does not have a job, then they're not going to go buy a home. So both of them are very closely related, and the U.S. labor market has to improve a lot more significantly in order for the housing market to improve as well. So the housing report on Monday may not be very strong. However, the rest of the reports do not look too shabby, with maybe the exception of the consumer confidence index, which could follow a decline, unexpected decline last Friday that we saw in the consumer sentiment index. Consumer confidence in the U.S. is expected to be a little bit lower, with a reading of 70.5. That is a little bit lower than a 70.8 in a previous month. I would not be surprised if the consumer confidence index, however, is a little bit better than expected on Tuesday. But then on Wednesday, we're going to see the U.S. durable goods orders, which are expected to show an improvement, month-over-month increase by 1.5% compared with the 3% decline in January. In February, 1.5% increase. This would be a positive report, or 3% increase compared with the minus 3.7% decline in the previous month. The 1.5% increase is for the core durable goods orders. So that would be a positive report on Wednesday from the U.S. On Thursday, the U.S. GDP is expected to be confirmed at 3% quarter over annual for the U.S. economic growth in the fourth quarter. That means the U.S. economy actually grew by 3% in the fourth quarter of 2011. Excuse me. And that, of course, would be a positive report as well, provided that the number is not revised lower to show smaller than expected economic growth in the U.S. That would be a negative surprise, but the consensus forecasts are expecting for the number previous estimate to be confirmed at 3%. And then on Friday, we are going to see a couple of other important U.S. economic reports with the personal income and Outlays, which also contains the preferred gauge of inflation by the Federal Reserve, which is called the Personal Consumption and Expenditures Price Index. And the personal spending in that report, component of that report, is expected to be very strong. Personal spending increasing by 0.6% month over month, compared with a 0.2% increase in January. In February, up by 0.6% month over month. Why is that important? It is important because the U.S. economy is mainly consumer spending dependent. The larger part of the U.S. economy is services related, which are obviously dependent on consumer spending. So as long as the consumer is spending, that's a sign that the economy is improving and strengthening, and that is what we could see with the personal spending component of the PCE report. Also, the core personal consumption expenditures price index, which excludes volatile items like food and energy costs. Now, if you include them, obviously you will see an increase in inflation pressures, but the Fed prefers not to include. So a core personal consumption expenditures price index is expected to show an increase by 0.1% month over month in February. That is down compared with a 0.2% increase in January. What does that mean? Well, that means that the Fed's preferred gauge of inflation is not going to show inflationary pressures rising according to that index. And, of course, if inflation is not rising, then the Fed doesn't need to make any changes to its existing ultra-accommodative monetary policy. Then this report is going to be followed by the U.S. Consumer Sentiment Index, which unexpectedly declined with a preliminary estimate last Friday to 74.3. However, the revised estimate next Friday is expected to bring an upward revision in a consumer sentiment index from 74.3 to 75.1. So this will wrap up the sequence of important U.S. economic data for next week. And as you can see, the majority of the U.S. economic reports are pointing to a little bit another week of mainly positive U.S. economic data. So as long as that continues to be the case, the U.S. dollar could continue to benefit from the improvement in the U.S. economic data and the U.S. economy in a way that it reduces the odds that the Fed will do more quantitative easing, which of course will be U.S. dollar negative. Next week is also going to give us an opportunity to gauge economic activity in the U.S. and in the United Kingdom, as the U.K. GDP report is due on Wednesday morning at 4:30 a.m. Eastern Time. Now, it is well known, because of the preliminary estimates in the last couple of months, that the U.K. economy did not do well in the fourth quarter of 2011. It contracted by 0.2% quarter over quarter, compared with 3% increase in the U.S. So it's a very stark difference as far as economic growth in both of these large economies. The final reading for the United Kingdom's GDP in the fourth quarter is expected to be confirmed to show the economy contracting by 0.2% quarter over quarter. Of course, that's largely has already been priced into the dollar and British pound exchange rate. So provided there are no surprises, no changes to that number, the report may not have that much of an impact. And ultimately, the pound-dollar pair could stay confined within its existing range. The pound-dollar pair is yet another major currency pair that has been confined in two ranges since pretty much October of last year. Now, many of you who attend this webinar on a weekly basis would remember that the lines are still there. They have not been broken. The large range is roughly between the large quarter point at $1.5250 and the high from October at $1.6165. Since October of 2011, that range has not been broken, neither above nor below. Within that larger range, in the recent couple of months, the pound-dollar pair has established a smaller range, which is roughly between $1.56 and $1.60 area, with an even smaller range there between the bottom at the $1.5643 and the top at the $1.5927. So this is where the pound-dollar pair continues to stay confined within. Earlier this week, the pound made an attempt to challenge the top of the existing range of $1.5927. It reached as high as $1.5817, however, 3 days ago, did not break above the top, and it's pulling back and it stays below the top of this range. I am expecting more of the same next week. I'm not seeing, even if the pound were to break above $1.5927, then it will encounter resistance of $1.5991, which is approximately the large floor point of $1.60, and it will still be confined at that point below $1.6165. I'm just not seeing the catalyst next week that could serve as a catalyst for the pound-dollar pair to break outside of the smaller range, to break above $1.60. And even if it breaks above $1.60, although it could challenge $1.6165, I still do not see a catalyst for the pound-dollar pair to break outside of the larger. And if we continue to see more of the same, if it becomes apparent that the pound is incapable of breaking above these two resistance levels, $1.5927 and $1.5991, then it should not be unrealistic to anticipate a move that could take the pound-dollar exchange rate down to challenge the bottom of the existing range, whether that is $1.5643 or even the recent lows a little bit above $1.56 at the $1.5601 from March the 12th. That, of course, doesn't mean that there are no opportunities when it comes to pound-dollar pair. Although it's been trendless and trading in a range sideways since October of last year, these two ranges, once a trader is familiar with them, knows what serves as the top of the range and what serves as the bottom of the range, when the tops or the bottoms of these ranges are approached, opportunities could be explored. But if one is looking for a definite trend direction, for the pound-dollar pair next week? I doubt that there will be such. More than likely, more of the same price fluctuations within the well-established range that the pound-dollar pair has been trading within. Moving forward with the important economic reports for next week, I already mentioned we'll have the durable goods orders on Wednesday. We're going to see the U.S. gross domestic product report, which is expected to be confirmed at the same price, as the same growth level, 3%, in the fourth quarter of 2011. And that's going to lead us to the important report next Thursday night from Japan. Consumer Price Index, which is the preferred gauge of inflation by the Bank of Japan. Now, why is that report so important? It is important especially because in recent months, the Bank of Japan has started talking about something that they have not considered before, and that is establishing an inflation target around 1% for Japanese inflationary pressure. This is the main gauge of inflationary pressures in Japan, and it is expected next Thursday night to show that deflation continues to be a problem for the Japanese economy. A reading of minus 0.1% in the core consumer price index year over year is expected. Now, below zero, obviously, that's in inflation territory. And although it may not be as deep in deflation territory, it still is a reading below zero. And if that continues to be the case, the Bank of Japan officials could continue to talk about doing more to create inflationary pressures in Japan, which ultimately has been one of the very successful tools that finally, after 5 years of decline, consistent declines for the dollar against the yen, has helped the dollar bounce off of the bottom and at least go through a larger price correction of these multi-year losses that the dollar has registered versus the Japanese yen, including new record post-World War II lows for the dollar-yen exchange rate. Now let's take a look at the daily chart of the dollar versus the Japanese yen. Many of you who listened to the webinar last week would remember that I warned that the current rally of the dollar versus the Japanese yen is becoming too extended for my personal taste. And I explained the two scenarios last Friday that we should monitor for this week. The first one was the bullish for the dollar scenario versus the Japanese yen. After a brief pullback, I said that we could see an attempt for the dollar-yen pair to establish another, what I would call, bullish trend wave on its daily chart. After already registering three, first one, this is the second one, and this is the third one. After a brief price correction, the dollar found support. Following the third bullish wave, price correction, the dollar pulled back from the high at 84.17, and it found support at the 83 yen level. After which, the dollar made an attempt to produce another fourth consecutive bullish trend wave. Now, if you've read my book, The Quarters Theory, you know that I talk about what is an extended trend wave sequence. Any trend wave sequence which is lasting for more than three waves in the same direction is what I would classify as an extended trend wave sequence. And of course, this, for the lack of a better word in my book, I call it the Quarters Theory trend waves, based on, of course, Elliott, classic Elliott waves theory and pattern. What is important, however, is an important difference between my version and a classic version, is that I do not put a limit on the amount of waves that the market can produce. You would recall that in a classic Elliott wave pattern, there is three waves in the same direction and a couple of corrective waves that should follow. But that, as many of you have noticed, is not necessarily the case all the time. As a matter of fact, we can see more than three waves in the same direction. In my book, I actually give an example of 7 consecutive waves in the same direction. Now, although the market can produce these overextended trend wave sequences, anytime we get to see a wave that is going to be following a perfect 3 trend wave sequence, we have to be aware of that red flag that is waved at that. And it's a warning that the trend wave sequence may become extended. And what that means is that when we have, for example, the dollar yen producing 3 perfect bullish waves, gaining over 800 pips in the process, and attempting to produce a 4th bullish wave, we should be aware not only of the scenario that anticipates that the 4th bullish wave could break higher and the dollar could continue to gain versus the Japanese yen, but we also should be aware of the scenario that I prepared you for last Friday on this program, where the 4th bullish trend wave fails, and as a result of that, as I also explained in my book, we can anticipate if a trend wave fails. In most instances, we can anticipate that a trend wave failure would be followed by the development of a reversal trigger wave, as I call them, in the opposite direction. In other words, as I said last Friday, if this 4th bullish wave on a dollar-yen daily chart were to fail, then we can anticipate the development of a reversal trigger bearish wave, which would be a corrective wave by nature. It would be an indication that a larger price correction of the dollar's gains versus the Japanese yen in the last couple of months is finally starting to kick in. Something that I've also been calling for a couple of weeks now, at least, and warning about that price correction that is long overdue of the dollar's gains versus the Japanese yen. And throughout this week, we saw an attempt for the dollar-yen pair to produce another 4th bullish wave. A couple of days ago, it reached as high as 84.08. However, that was not enough to break above 84.17. This led to the 4th bullish wave to fail. Now, again, this is not a rocket science. If this should be a continuation of a previous bullish trend, you have to produce higher highs. So if the 4th bullish wave did not produce a higher high than the high of the 3rd one at 84.17, then that's a sign of the bullish wave failing. And as I explained earlier, as a result of that, in most instances, we can anticipate the development of a reversal trigger wave in the opposite direction, which would be a reversal trigger bearish wave in the opposite direction of 4 bullish waves. That reversal trigger bearish wave starts the larger price correction of the over 800 pips of gains that the dollar has produced versus the Japanese yen in the last couple of months. Many of you would remember that the dollar found support above 76 yen and has rallied in the last couple of months to as high as 84.17 yen. In terms of my quarters theory, I also propose that every significant price move occurs from one large quarter point targeting another large quarter point. In other words, the prices do not move in a random fashion, chaotically and randomly, but rather in an organized manner, targeting these large quarter points. So during the 4th bullish trend wave, the dollar made an attempt to move higher again towards the 85 yen large quarter point. However, that quarter between 82.50 yen and 85 yen was not successfully completed. As I explained in my book also, as a result of an unsuccessful completion of a large quarter, in most instances, we can anticipate that a reversal will occur that takes prices back to the preceding large quarter point, which in this case was the 82.50 level, which the dollar-yen challenged as of yesterday. Yesterday, the low was 82.32, which is only 18 pips below 82.50 large quarter point. And because of the existence of that support level area here, let me show you the line here. That is a important support level here area for the dollar against the yen, because you had last week support at 81.95, which is only 5 pips below the 82 yen level. and double top resistance at 81.86 yen. Both of these numbers are shortly below the 82 yen level. This could be the next level of support that could be targeted as the dollar retraces and corrects some of its over 800 pips of gains in the last couple of months versus the Japanese yen. Now, this area is also going to be very important because it would tell the story as to whether or not this price correction would become even larger than it is right now. I mean, right now, the dollar is reaching as low as we speak, new intraday lows at 82.10 yen. So it is approaching the 82 yen area, and those support levels at 81.95 and 81.86 that were established in recent weeks. But a break below that support area could mean that the market could decide to go with larger, up to 50% Fibonacci. Perfect, to a lot of traders call that the so-called perfect Fibonacci retracement of exactly 50% of the dollar's gains, which are not very difficult to calculate, by the way. If the dollar gained 815 pips, to be exact, up to the pip, the dollar has gained 815 pips, a little bit over 800 pips in the last couple of months versus the yen. So what would be the 50%, perfect 50% retracement? At least 400 pips lower for the dollar against the yen. With recent highs being at 84.17, 400 pips lower, that could take the dollar versus the yen towards the 80 yen area. With another double bottom support shortly above the 80 yen area, and that's the 80 and a half. 80.57 is that exact level that I'm referring to. This could be the next level of support. This is why I said the 81.86 to 81.95 area support will be an important level to watch next week. Because if that level is broken, then the price correction could extend even further, where the dollar could drop towards the 80 yen area and challenge at least the double bottom support at 80.57 yen. Now that, of course, would be the bearish for the dollar scenario. After this healthy, long overdue price correction for the dollar versus the Japanese yen is over with, however, I anticipate that we may see a continuation of the dollar's gains. Not necessarily. This rally of the dollar against the yen is still, to me, not a reversal of the multi-year bearish trend for the dollar. So I do not want to be misunderstood. But what I'm talking about is an even larger price correction of the dollar's loss in the last 5 years against the yen. Many of you who have a short-term memory may not remember that 5 years ago, the dollar-yen exchange rate was above 124 yen. So if you do the math, you will see the significant losses that the dollar has registered during a 5-year, multi-year bearish trend versus the Japanese yen. 800 pips is merely a small price correction of the dollar's losses in the last 5 years. And that price correction could resume further, with the dollar correcting even more and heading further into this new 1,000 pip range, which it entered in early February. And that's what I'm referring to is the 1,000 pip range between 80 and 90 yen. You would recall that the dollar-yen exchange rate was confined between 75 yen and 80 yen into the 70s 1,000 pip range for a number of months. Early February is when we get to see the dollar actually finally breaking above 80 yen and transitioning its exchange rate into the 80s. And that's important because on a pullback towards 80 yen is going to be crucial for the dollar to stay above 80 yen. And if it does, then we can anticipate further advancement for the dollar-yen exchange rate into the 80s, back towards the recent highs at 84.17, maybe even challenging the high of 2011, which would be 85.51 yen. Now, if the dollar were to break below 80 yen, then obviously that would be a sign of weakness. So it's a very important price correction that's taking place that I've been calling for, because it will tell us the story, whether this move and recovery of the dollar versus the Japanese yen is real, or whether the dollar loses momentum and slowly but surely starts fading away again and giving up all of these gains in the weeks and months to come. So next Thursday, the Consumer Price Index report is going to be important as well, because if deflation continues to be a problem and on the radar screen of the Bank of Japan, Japanese officials could continue to do more to create inflation, which is not a Japanese yen positive. Now, a lot of people in the media have written that it was unexpected that the Bank of Japan decided to increase the size of their asset purchase program or quantitative easing program by another 10 trillion yen. If you listen to my webinars or if you listen to the All Things Forex broadcast, this was hardly unexpected. It was rather very well expected, and it made perfect sense. As we've been paying close attention to economic conditions in Japan, they deteriorated again in the fourth quarter of 2011. This is why I've been saying since then that it would make sense for the Bank of Japan to do more quantitative easing, because it's a perfect tool as to what the Bank of Japan wants to do. And that is two things: stimulate the economy and at the same time weaken the Japanese yen. And quantitative easing is a perfect tool for that, and coupled with creating additional inflationary pressures, which could help reduce the deflation threat in Japan. So it's not shocking to see what the Bank of Japan did, expanding the size of the quantitative easing program, beginning to talk about an inflation target, and attempting to weaken the Japanese yen. This was all expected. Earlier this morning, or last night I should say, the Bank of Japan Governor Masaki Shirakawa said that the government and the Bank of Japan are on the same page as far as the future goals. They said they both share the same view on the need to beat deflation. What does that mean? More talk and more prospects and higher odds that the Bank of Japan could continue with the current accommodative monetary policy, with even more quantitative easing. And you may read that this was again unexpected in upcoming months, but it is expected. It does make sense at this point. And considering the recent Japanese yen weakening across the board, not just versus the dollar in the last couple of months, this is obviously a policy that's finally beginning to bear fruit. So why change it? It makes perfect sense not to change it. This is why I'm saying that after the dollar's healthy price correction, especially if these continue to be the expectations, that the Bank of Japan will do more, will stay accommodative, will continue to talk about the inflation target, which has been a very effective tool as far as weakening the Japanese yen. Why should we not anticipate the dollar to continue to strengthen throughout the second quarter, perhaps even, of 2012? As long, of course, as the U.S. economic conditions continue to improve, because that's very important to watch for. If U.S. economy deteriorates, then the odds of the Fed doing more here will also increase, and that will not be a U.S. dollar positive. But as long as the U.S. economic data continues to improve, and as long as the Japanese economic data does not improve significantly, then we could see some even more stark differences in expectations of future monetary policy by both of these major central banks, the Bank of Japan and the Federal Reserve in the United States, in a way that the Fed could steer further away from monetary policy accommodation, consider potential exit from its accommodative policies sooner rather than later, while on the other hand, the Bank of Japan continues to be accommodative, continues to expand their quantitative easing efforts, and continues to its attempt to create inflation and to weaken the Japanese yen. This is a major factor that going forward should be watched very closely if one were to attempt to gauge the future direction of the dollar-yen exchange rate. So that about sums up the list of important economic events for the new trading week. I did not mention one of them, and that is number 8, which will be the one from the Eurozone with the flash harmonized index of consumer prices. The preliminary estimate of inflation, the main gauge of inflation in the Eurozone, which is the preferred inflation gauge by the European Central Bank. A couple of weeks ago, when we watched the market's reaction to the European Central Bank interest rate announcement, we noted that inflation was back on the radar screen of the European Central Bank as inflation pressures increased from 2.6% to 2.7% year over year. However, next Friday, the Eurozone flash HICP estimate is expected to show inflation pulling back from 2.7% down to 2.5%. And if that is the case, if that consensus forecast is accurate, then we could see inflationary pressures beginning to subside again in the Eurozone, which creates a more comfortable environment for what I said earlier could be the case. The European Central Bank considering more accommodative policies and including potential interest rate cuts in the near future. If economic conditions continue to deteriorate in the Eurozone, if the recovery in a first quarter was of wishful thinking, and the reality is that there was another quarter of contraction in the first quarter of 2012, and ultimately, if the European Central Bank is expected to cut rates going forward, and if the market starts pricing in these such expectations more aggressively, then that, in my opinion, would not be a very positive fundamental factor for the euro. It should be an interesting trading week next week. Don't forget it is the final week of the quarter, and therefore there may be a lot of window dressing, a lot of reshuffling, repositioning there ahead of the end of the quarter from major institutions. So we could see more range-bound trading, but more volatility as well. The market's been so choppy in the last couple of weeks, especially this week, and I expect for that environment to continue throughout next week. If you would like to listen to my daily outlook on the major currencies and latest developments in the currency markets, I invite you to listen to the All Things Forex live daily broadcast Monday through Friday on my website, allthingsforex.com. You can also follow me on Twitter at allthingsforex is the account at allthingsforex. Thank you all very much for attending today's webinar. Have a great day and a great weekend, and I will see you again next Friday at 10 a.m. Eastern Time.